All right, so to begin with, what is accounting? I know, maybe you have read somewhere, maybe you have heard somewhere, or what do you think about when you hear the term accounting? All right, so with me here, I have two definitions. So the first definition is saying accounting is the process of identifying, measuring, and communicating financial information to permit informed decisions by users of the financial information. So this definition now is from Frank Wood. So another definition says accounting is the process of recording financial transaction, producing financial statements, and analyzing the financial performance of the business. So this is David Warren. Now, from the definitions, you will notice that there is a pattern saying that the first one, I like this one saying the process of recording, because recording was data. So in the first place, when a business if you start a business, you have different activities that the business is doing when it comes to finances. So all those financial activities that the business is doing is financial data. Okay, whether you're getting a loan, whether you're paying for something, whether you're spending for goods and services, those are financial data. So that financial data need to be processed by the end of the day so that you as a business owner should make the decision, informed decision, okay, to track the financial performance of your business. So in this case, we are saying that we are identifying. So identifying in this case, we are trying to identify the financial data that our business for the past 6 months or for the past 12 months, this is all we have been doing. So by the end of that period, you identify all those transactions. Okay, in this case, you have recorded them. So all the transactions have been recorded and then need to be processed or need to be analyzed, because it's all about having data and producing what? Information. So in between now and here, between data and information, in between there is processing of that information. But the information that we are dealing with in this case is the financial information or the financial data. In this case, financial data is financial transactions. So financial transactions, by the definition, I would like to define them as these are financial business activities that involves buying and selling, lending, paying for something. So all those activities that the business is involved in terms of their finances or economic activities, call them financial transactions. Okay? So if you are starting a business with a certain amount, or you don't have an amount to start a business, so you are borrowing, that's a financial transaction. You are paying for wages, that's a financial transaction. That's a business activity. So by the end of the day, all those activities that have been incurred in the business, they need to be analyzed. Okay? So you have to analyze. The reason behind analysis of the financial data is because you want to come up with information. The information now should help the users of that information to make informed decisions. So in this case, users of financial information, we are going to discuss those in the next video. But for now, users of those financial information, they need to make decisions. For example, manager need to make decision on how they envision the business based on their financial position. In the next period, where should we stand as a business, as a director, as an investor, as a supplier? So all those information, they need to help all those stakeholders to make decisions regarding to the performance of the business. So that's the idea behind accounting. So it's all about recording the data. In this case, the data that we're recording is all those financial activities that the business is doing. So there's a person special who is supposed to record this information, is known as a bookkeeper. So we're going to discuss who a bookkeeper is. So a bookkeeper now records all those information, each and every day transactions in the accounting books of the business. So that by the end of the day, an accountant in this case now is supposed to come in, check in all those financial transactions, analyze all those financial transactions, produce statements, and then those statements should help the business to make informed decision. After checking how the business is performing, so they need to make decision. Say, okay, our business is not doing well. We need maybe to get a loan because it seems like we're lacking capital. They know that they don't have enough capital. After they have analyzed all the activities they have done and they have come up with the information to say, seems like we are undercapitalized. So what should we do? Let's get a bank loan. Seems like we're making losses. What's the reason behind this? Or maybe we are overexpending. How do they know that they are overexpending? Unless if all the expenditures that they have been doing, they were tracked and they have been analyzed, they have produced financial statements to see how they are performing in terms of their expenses and come up with profit or losses. So there are some of the things that need to be done. So there is a recording, and then there is analyzing, measuring, and then there is communicating of that financial information. So when you have recorded, the bookkeeper is doing this, and then you have analyzed, all the transactions have been analyzed in this case to produce the information. Now, information need to be communicated. So when you say measuring now, it's like the extent of how much have we spent, how much have we lost, how much have we gained. So in this case, after that now the information need to be communicated to the users of those financial information. So all the users of the financial informations are the ones now who want now to make decision with the information. To say, okay, so for example, I am the user of the information. I'm the supplier, for example, in this case. I supply raw materials to the business. So if I know that the business have produced the information and they have supplied the information to me, like they are making losses. So I, as the supplier, in this case, I'm going to make the decision to say, okay, if I supply my resources to this business on credit, they say they will pay later. If they're making losses, are they going to manage to pay me later if they're making these losses for this consistent time period? For like 2 or 3 years, are they going to manage to pay me if they're just making losses? So now I make the decision to say, okay, if the business is not making profits, that means they are not in the capacity to pay back all their debts. So I'll quit from the supply. Say, okay, I'll stop supplying the business. If I'm the manager now, if my business is making losses, now I need to make the decision to say, what should we do? Maybe we are overspending. Let's lay off some employees. Okay? Maybe we are overspending on, some of the cost centers are just too much. So we need to cut off the expenses. We need to cut off costs. We need to, find other economies of scale. We need to produce at a very large amount of goods, but at a very low cost of production. There is a high cost. We are spending so much. That's why I'm making losses. So it's just a matter of making those decisions as a business to improve its performance as it goes. So here I wrote this say, all that information produced by the accountant. So some of the information, general information that need to be produced is presented in these financial statements, which is a statement of financial position and the income statement. So in a statement of financial position, this is where now the business, they track all the resources that they own. This measures the worth of the business in terms of the resources they have. So if the business says they are bankrupt, they know that if they produce the statement of financial position, it tracks all the business resources owned and all by the business. Those borrowed, those provided by the owners, and the ones they really own. Now, income statement now, this one is used to produce profits or losses. So if we are involved in a trading business, for example, if we are buying goods and we are selling them, we need to make profit, to produce profit, to say, okay, we ordered this amount of goods and we have sold them at this price. How much have we made? They only know that if they produce income statement. So these are general financial statements that are produced by all businesses, whether a sole trader, a partnership, or a company. Okay. Of course, as you go into different business structures or business organizations, you find out there are also additional financial statements that are produced. But basically, each and every business, whether being a sole trader, partnership, or a company, they need to produce these two statements. There are two main financial statements in accounting. All right. If you're in my class, I will ask you, do you have any question? But let's proceed.